Good evening, everyone. I am Twisha Shah, a part of the Investment Solutions Group at Avendus Wealth, and I extend a very warm welcome to all of you. This is the second session of our Bespoke series. As you all know, Bespoke is an Avendus Wealth initiative for engaging with our clients on topics and themes that matter to them the most. So today, our endeavor is to answer the question that has been at the forefront of all our discussions with our investors, and that is, what is the outlook on Indian equity markets going forward, especially considering the phenomenal rally that we've seen over the past 18 months. And the current macroeconomic backdrop will make for a very interesting discussion today, given that we are poised to enter an interest rate cut cycle that was last seen back in the global financial crisis in 2008. What is all this going to mean for our portfolios back home? Especially now that the event risks that are unique to India are now behind us, what is next for the Indian equity markets? What could be the impact of some of these global developments on our portfolios? What should investors do? Could there be a correction that could provide for a better opportunity for investors to invest? These are just some of the questions that will get addressed today. With this, let me introduce our panelists for today. We have with us Saurabh Rungta, Managing Director and CIO of Avendus Wealth. We have Shravan Srinivasula. He heads our investment solutions practice. We have Anirudh Gangahar. He is the lead equity strategist at Avendus Wealth and also the head of direct equity. Swati Singh, she is the head of fixed income. And we also have Mark Yotishen from our offshore desk, who joins us from our Singapore office. So for the flow that we have set out for today, this session will be in three distinct parts. First, we'll give it over to Mark from our offshore desk. He will throw some light on India from a global lens. This will be followed by Anirudh, who will take us through where we stand today and what can we expect from Indian equity markets going forward. This will be followed by Shravan, who will address the question on what investors can do going forward in terms of their portfolios on a whole. We will then open up for Q&A, and we'll request our participants to keep typing the questions that keep coming up in their minds in the chat box at the bottom of their screen. Please note, we will not be able to answer any particular stock-related queries. This session is strictly for an investment strategy perspective on a macro level. I now hand it over to Mark for the opening address.
Yes, so a very warm welcome to everyone. So I would give a perspective. I'll set a bit of the global context, and also, how is the global institutional investor base really looking at India? Certainly, there's a few ways we can look at how global investors are looking at India equities. Number one, we could really look at a lot of the research outlooks published by, manufacturing houses globally. But of course, that is going to skew the perspective because, different investment houses are going to publish positive or neutral views on India equities depending on the products they have. So another way I could kind of look at what's the global sentiment to India equities is really looking at what, global emerging market institutional managers are really doing, kind of see what they do rather than what they say. You kind of open the bonnet and see what's their portfolio and what's their India equity exposure relative to the MSCI Emerging Market Index. So if we move on to the next slide. So this gives a bit of a more objective flavor of what really is the global sentiment towards India equities. A few caveats here. So a lot from an absolute perspective, if you look at the time trend from March to July today, a lot of the biggest global EM funds, so I've selected 6 of the biggest emerging market funds based on AUM, and a lot of their India equity exposure have increased on an absolute basis. But, if you adjust for the benchmark as well, the benchmark has also increased. So relative to the benchmark, actually a lot of the global institutional EM managers are still relatively underweight. Of course, so if you to interpret the color dashboard, anything that is red essentially means that the institutional fund manager is underweight relative to the index. So there could be perhaps some reasons, and some of it will be anecdotal as well, given that I'm sitting here in Singapore and a lot of the global managers are sharing their views. A lot of them are certainly concerned about the valuations. Now, the long-term fundamental stories of India as a growth story, the consumption, the growth, and the long-term economic potential is very well known. And why has it not led to an overweight, with the exception of Fidelity? Why has many global institutional emerging market managers remain relatively cautious or even underweight? It really has to do with valuations. So a lot of them have a bit of a value bias when they navigate emerging market portfolios. And number two, when valuations are stretched, despite the strong outlook, a lot of them are very concerned, with that little margin for error. And more importantly, as Aniru later would share, that, there is strong retail inflows, which is really kind of offering a support on India markets and has really made it hard for a lot of these institutional investors to identify value opportunities. So a lot of this underweight, to sum up this slide, a lot of the underweight does not reflect their negative outlook, but is very much on valuation concerns. If we move on to the next slide. And you can see that really reflecting I intentionally called out that column from the 52-week high. India has pretty much not moved. If not, it's pretty much at its high compared to global markets. We have seen some of the global developments, and India has really performed very resiliently relative to other parts of the global markets. So that, of course, even add extra caution that, how long is this rally going to continue on a forward-looking basis? And if you look at the PE, the forward PE, India is on par with, markets like the US, where already the global institutional managers are very concerned about the expensive valuations on US, and India is pretty much trading on par, if not more expensive in the area of mid-cap compared to the US. So that perhaps also gives another reason why global emerging market investors are a bit more cautious to India equities. So if we move on to the next slide. So this also gives you a perspective on the year to date. Despite all the valuation concerns, India, the equity index I've taken, MSCI India, they have performed relatively well compared to other parts of the EM. In fact, if you compare China, South Korea, Brazil, Mexico, India is clearly the star. So if we move on to the next slide. So, of course, there is a lot of talk on, as Twisha has started off the webinar, that, we are expecting a Fed easing cycle, the USD currency relative, not just to the rupee, but to global currencies, is really at overbought levels because of the high interest rates. And we are expecting that to come down as the Fed eases. So we would expect USD weakness. And what would that be the outlook for EM equities in general? If we kind of trace the correlation in the last 15 years, we can really see a strong inverse relationship. So as the USD weakens relative to global currency, EM equities do appreciate. And there are this is well known, but of course, some of the mechanisms why this relationship remains very strong, really much because emerging market governments, even including India, could benefit from a weaker US dollar by borrowing money in USD terms. So there are quite a few countries that they cannot borrow on their local currency because it wouldn't attract sufficient international demand. So they would borrow in USD dollars. So when that weakens, the cost of servicing will be lower, and EM governments are able to borrow more. So that's a boost to equities. Different economies, however, might be impacted differently. So while there is an aggregate trend that weakness will benefit the overall equities, the extent would differ. It really depends on the current account deficit within each EM economies. And finally, of course, some EM economies are more driven by commodity exports. So when commodities are priced in USD, if the currency depreciate, there could be some boost on the commodity demand as well. So again, that's another mechanism linking USD to EM equity outlook. So then, of course, the key question then, what is the current outlook on global economies? And that would set a very nice stage on how this links to India. So US is facing disinflation. Disinflation is on its trend, and there is a moderating economic activity as the economy is moving into a Fed easing cycle. There has been a lot of headlines on growth scare. Market is gonna swing between inflation scare and growth scare. So we would expect equity volatility to pick up, but nothing to really suggest we're gonna see a type of 2008 contraction. If we look at some numbers like, a more holistic indicator like leading economic indicator, it suggests a slowdown, but nothing too contractionary confectionery. And then if we look at China, China is facing its own economic cycle. And of course, we look at the headlines and even the upcoming macroeconomic data. The recovery, the much awaited domestic recovery, is much slower. If not, it's still facing some headwinds. So, there is no positive catalyst to China yet, but the equity fundamentals are not as weak as the macro headlines suggest. And in fact, consensus earnings for a lot of these Chinese equities remain quite healthy at full year, financial year 2024 at 14% growth and 2025 at 12%. And because the starting valuations are very low, there is a lot of potential for positive surprise. China macro normalizing, companies delivering better than expected earnings. And finally, Japan. Japan has been at the limelight, and there is a lot of validation to market optimism on Japan. So 2023 is when the rally of Japan equities really started. And 2024, we are seeing some validation on the macro front, where we are seeing more household. Historically, they hold a lot of cash. Now they're actually investing into domestic capital markets, as well as we're seeing a lot of Japan firms actually embarking on M&A. So this is a very positive development on corporate behavior. Yen would remain vulnerable to some of the uncertainty, but this does not really invalidate the long-term structural growth of Japan. So that sets the context. If I were to sum it up, especially US having a lot of attention, there will be some moderation of economic activity as we move to the Fed easing cycle, and perhaps after the election, a lot of uncertainty might dissipate and we might see a bit of recovery. But right now we're seeing US kind of stagnating, and that would have implications to the India equities, as Anirudh is going to talk you through.
Thank you, Mark, for that very insightful discussion. I'll hand it over to Anirudh now, who will cover the Indian equity backdrop for us.
Thanks, Twisha, and good evening to everybody who's joined in. The big question is there a big correction on the horizon? Just to put into perspective and carrying on from what Mark said, let's start with looking at some of the historical returns and just put certain returns into perspective. We do all have a recency bias. Most of the people who are new to the capital markets and equity markets post-COVID particularly have not seen a down cycle. But just to put it into perspective, the average any CY return for the Indian markets has been all but low teens. This excludes dividends. So you add dividends, it'll be about 1.5% more. But if you look at the index-wise, last 10 years, the average or the median return has been 12 to 13%. These are the exhibits on the two left-hand side. And on the right-hand side exhibits is, if you do look to invest into equities from a 3-year holding period horizon, then on any calendar year or a 3-year CAGR, it seldom crosses the 20% mark. It just tends to average out. And the bottom right chart probably would be more interesting because everybody wants to talk about mid and small caps. And you can see that probably the last time we saw this kind of a 3-year CAGR was back in 10 years ago. And we kind of are at the same level, and now we are moderating a little bit. So the question is that are we peaking as far as forward-looking returns are concerned? And keeping in mind that the averages have been low to mid-teens or so. If we move on to the next slide, and keeping this particular perspective in mind, where do we really stand? We kind of talk about it that the markets are expensive. How really are expensive? Most people understand this from a PE perspective, and markets are known to be forward-looking. So the best probably proxy can be the forward-looking PE. And the 4 charts that you see are the 1-year forward-looking PE for the Nifty small cap 100, mid cap 100, and the BSE 500 taking as a proxy for the broader market. And we compare it to their 7-year average. Now, what's the golden rule for 7? Why not 10? Why not 15? Well, the longer you go, the worse you're going to look. But if you look at just 5 years, then 5 years would probably have a bit of a skew thanks to the up and down movement on account of COVID, related downtick and uptick. 7 years still seems to be capturing a reasonable amount of cycle. And on that level, the Nifty is at a 12% premium. The mid caps are at a premium of about 50%, 50. while the small cap is at about a 34% premium. This obviously is based on earnings expectations as per Bloomberg for the next 12 months. But come what may, whichever way you want to look at it, I think we need to be honest enough to say that yes, Indian markets are good. Indian markets have not delivered negative returns, but we also have to say that yeah, they are a bit expensive, particularly if you look at what historically the return ratios have been. Moving to the next slide, the question is that a little bit what Marx mentioned, that are we in isolation in terms of how we've moved up in terms of valuations, or other markets have also given a very good change as far as valuation is concerned. We put out a monthly note, and we typically took out the PE valuation numbers for some of the indices that we follow, which includes the S&P 500 from the US and the MSCI Emerging Markets Index. And we noticed that indeed the valuation multiple for across the world has moved up in the last 6 or 7 months or so, particularly this calendar year. And the Nifty multiple actually has moved up not very much, in fact, from where we started off. It was a higher base, of course, but small mid-cap multiples again are north of 25% uptick. And Mark did mention about the MSCI India index and the emerging market index versus the dollar index, which is has an inverse relation. As you can see that on the right-hand side chart, the pink line, which is the dollar index, it begins to go down, and emerging markets, including MSCI India, which also had a bit of a uptick as far as weights are concerned, has indeed seen a bit of a rise up. So if the DXY of the pink line drops a bit more, that means if dollar weakens a bit more, that is something which probably should be positive as far as the MSCI India, or therefore investment of foreign money into India, is concerned. Moving on to the next slide. What are we really looking at as far as valuations are concerned out here? I think if we look at, again, the same charts are there that, we're looking, I think probably this slide has been actually repeated. My apologies for that. Looking at the next thing is the flows. Probably the one big thing which probably separates, old timers like me who've seen markets for 20 odd years and always had this impression that beginning FII selling, the market will crash. Then it'll take a long time for the market to recover. Well, things have really changed since the COVID uptick. And I think 2, 3 numbers which are pretty hard hitting. The first number is that since January 2022, FIIs have put in about $26 billion into the Indian equities. Now, what have DIIs done? They've done 59 billion. And the number is even starker when you look at since January 23. In net FI inflows are about 5 billion. DII inflows are 37 billion. Clearly, there is a new champion in the force as far as flows are concerned. And this is something that we've not seen before. And that is probably the reason why we see that everything is a buy on dip market, because the moment there is a selling, the flows which are incessant, as you can see from the bottom left exhibit, those are the rolling 3-month average of net inflows into equities and ETFs. The number has just surged. I mean, as recently as December versus now, if you take the rolling 3-month average, you're seeing that the number is 1.5 times the number that it was back in December. Clearly tells you there's a lot of money standing, waiting to be deployed. And the reason why it's standing and waiting to be deployed, we'll talk a little bit more about it going forward. But it's because there are multiple factors, but one of the key critical factors is that the returns have not been negative and everything gets bought into. So all people who we analyze and we say valuations are expensive, basic rule of economics, if more money is chasing the same good, the price goes up. It's very clear more money is chasing Indian equities and the prices are moving up. Yes, difficult for us to put it into perspective mathematically why it's justified, but the valuations are moving up because there's a new force in town, and that is the domestic money which is flowing into equities incessantly. Moving on to the next slide. Couple of things now which are not so gung-ho. And this is where things turn a little bit moderating. Earnings growth in India has been pretty robust for the past 2 years. Last year, we clocked by most estimates a growth of about 20% across indices, maybe more as far as mid and small cap indices is concerned. But overall, the growth numbers are beginning to look a little bit lackadaisical. Most estimates are predicting now the next 2-year earnings growth for India to be around 13 to 15% at an aggregate level. This is lower than the 20 odd percent that we've seen in probably the previous 18 months or so. And therefore, the typical risk reward ratio, they're saying that, if you pay more for higher growth, well, growth is tapering in India, while the markets are not really, as you can see from the top left exhibit, the markets are not really correcting at any point of time when you look at multiples are concerned. But we have seen that Nifty tends to have a bit of a correction when it starts trading at about 21 times forward earnings. We are just at about that level right now, where we are touching 21. The broader market has actually moved up a little bit more as well, but now trades at about 23, while the earnings growth is 13. So the gap between earnings growth and the valuation multiple is what scares or what is a concern, I think, when we look at what the outlook for the market is. So from an earnings perspective and a valuation perspective, things are not looking that good. If you move on to the next slide, I tend to basically say that, look, I think probably there's one more slide which probably you can put in. If you can move to the next one, maybe yeah, I think this one I'll go with. This is a bit of gyan, yeah, for the lack of any other word. We all look at this particular aspect, the tailwind and the headwind. What is it is a big near-term correction. Now, the question is, what's big? We've not seen a big correction, with all due respect. Maybe intraday, we've seen on the budget day a 10% move up and down from the top to the bottom. But other than any external events, we've not seen any major correction in the market for quite some time now. Now, what's the reason and why the Indian markets still look good from a medium-term perspective? And I thought I'll just put things into perspective over here. I think the first one, which probably is the biggest long-term positive as far as India is concerned from equity markets, is that the growing equity culture in Bharat. I mean, mutual fund sahi hai. I think for people who understand this is something which is repeated in our minds and heads, and combine that with no negative returns. Obviously, you'll want to put money into equities. I mean, who wouldn't? Combine that with the mobile penetration. People in lockdown don't know what to do, have an option to invest. Some great apps coming up. App showing you into the elevator, you buy a stock, you exit the elevator, the stock is up 2%. Great thing, great culture. And I think all that is stuck. It's become a habit now. And also, I mean, on the serious note, even the government, actually, if you look at the budget policies, they've made equities a more attractive asset class as compared to some of the other asset classes. Probably Shravan will give some light if some things have changed at the margin. But overall, it's almost, you don't not left with any other option but to put money into equity. So I think there's a growing equity culture, money moving out of households in tier 2, tier 3 towns into mutual funds, which in turn want to invest, and they're waiting for things to invest. The second thing is sentiment. I mean, sentiment is driven by the fact that there's no negative returns. Everything which is negative, now people are used to it. Okay, it'll drop for 3 days, we'll just buy it. And somebody will buy it. And no new entrant, as I mentioned, has have seen some big GFC kind of crisis or a systemic crisis, which has taken the market down drastically. Third and fourth are pretty much well known. India still remains a very favorable position as far as the global world is concerned. Talk about China plus one, talk about anything else. The question is that, that in a world which is becoming more and more uncertain, there are very few areas which have got a combination of domestic demand capability, of servicing the exports and having political stability to a very large extent, and good GDP growth. So therefore, it by default becomes a good place for you to be investing money in, and India does remain that way, no matter what the valuation is even now from a medium-term perspective. And India's weight in benchmarks is only increasing. And finally, the people, as they were saying, Twisha mentioned, events have moved out. Some of the major events have moved out. What do you look forward to? Well, Fed rate cycle, 18 September, will be pretty much known where things are. But I think the next big trigger, which can be there for the Indian market, is something which is probably a year and a half away, which is the sovereign rating upgrade. If the government sticks to its plan of fiscal discipline and we manage to not have any mishaps on the way, India could become an investment grade institution across the world, and that by default will probably attract more money into equities, more foreign money into equities. So yes, there is still one big factor which can come across, which is going to lead this up, but till that time, it's all going to be about the domestic flows, unless and until the valuations drop. Now, look at the other side. What are the headwinds? I think every time you invest money, you should probably, in lofty valuations, as I said, you got to accept that it's an expensive market and the margin of safety is low. The margin of safety has been low for some time now, but what is also happening is now that the earnings growth is beginning to taper. And if you look at risk adjusted to growth or growth adjusted multiples, then they're looking a bit more expensive now than they were probably 6 or 8 months back. We are also seeing some exuberance reaching irrational levels. I think most of us would have seen what is happening to SME IPOs. You ask for 5 crores, you get 2,500 crores. And, the question is this really rational or not? Typically, it is known to be in the past signs of markets really becoming totally gone haywire as far as valuation and things are concerned. These are some of the alarm bells that we need to be worried about. And when more and more people try to justify fair values based on outlooks which are beyond 2 years, 3 years, 4 years, 5 years, then that you're pricing things for perfection. And if something goes wrong, then the floor is very far below, and goes back to the margin of safety. Also, the question about what Mark mentioned is the FII sentiment plateauing. I mean, we don't know whether it's plateauing or not, but certainly, as Mark mentioned, that in the global money is still a little bit underweight, even though brokerages are pretty much overweight, and still, yes, India still is the preferred destination. So I think there is a silver lining to that. That if it's plateauing, then probably there must be some reason why they'll re-engage, and that re-engagement could very well be if the markets cool off a little bit. But the biggest thing which I think that the market can lead to a big correction is unfortunately, in my opinion, something which is either a global risk off because of some event, some systemic issue in India, or some very bad adverse geopolitical event. This could very well be the Middle East crisis. What happens after the US president elections is over? We've been talking about the regulators and the RBI flagging certain concerns, trying to curb the enthusiasm, if I may, in certain pockets. There have been talks about certain, lending, certain things which are not really prudent. God forbid if there is something which turns out to be systemic, then again, the fast money will move out very, very quickly. And that will lead to a big correction, which means anything close to a 10% correction. A 3-4% correction is something which is not really a correction, even though the media will tell you something otherwise. And finally, if I move on to the previous slide to conclude, and I hand it over to Shravan, is that if I was to summarize, the question is that is a big correction due? It is due. Will it come through? Well, it probably needs a trigger bigger than valuations, because valuations have been expensive for some time now. All we will probably say is that if you look at the indicators, the macro indicators are positive to neutral. Our flows are exuberant. FI flows are calibrated. Earnings is moderating. Valuations are negative. Sentiment remains exuberant, and near-term outlook versus returns outlook versus the historical average is still pretty much muted. We think that you'll probably see a single-digit return on the Nifty from here on if the multiples do tend to moderate close to their 5-year averages over a 12-month period. And from a 3 to 5 year period, we're still looking at just about a low-teen return, which basically means that yes, we still have returns, but we could probably get some better entry points. And Indian market, by all stretch and means equities are a good place to be in as far as the medium term is concerned. Our preference would be large caps, followed by small caps, followed by mid caps as things stand today. Overall, we'll say that while the margin of safety is low, our approach and our advice would be to be selective and calibrated in your deployment. I think that would be doing well. Whether it's equities, in which fashion of equities, and if there are any other asset classes, I think I hand it back to Twisha.
Thank you so much, Anirudh. I think that's a great cue for what Shravan needs to cover. Our next section, Shravan, please cover your views on asset allocation.
Yeah, thanks, Twisha. Thanks everybody for joining in. Thanks for this opportunity. So first slide, I just want to talk about is have there been corrections in the past? The answer is yes. When you are in equity market, we need to be ready for a 20% correction at any point in time. The correction doesn't knock the doors and come; it comes suddenly, right? If you look at the last 4 corrections, year 2010-11, we have seen almost a 30% correction. This is taking back to the 2G scam, the policy paralysis issue that India has gone through. So in 2009, we started with a stupendous rally. In late 2010, it was the first glimpse of 2G scam which has come about, and it snowballed into other issues with the government, and finally losing interest of the investors, and which resulted in a probably a 30% correction at that point in time, but over a stretch of a period, right? In 2015-16 was a period where the Chinese slowdown happened. The commodities went into a TC, and so was the case with the emerging markets. India was also corrected. India corrected by about 25%. I'm not going to the previous history because 2003, 4, 5, 6 we have seen corrections happening. And last decade we have seen about 4 corrections happen. COVID, all of us knew. So Feb 19th was when the glimpse of the COVID thing started happening, but it only in the later part of May that the steep correction happened, fell by about 40% or so. Very recently in 2022, this was the Russia-Ukraine issue, and suddenly the markets fell about 18-19%. When I say markets, is the Nifty that I'm talking about. And 2018, it's not evident here, but small and mid caps had their issues, and they corrected by almost 20-25%. Right now, you see the one-way rally that we are seeing in the markets. Now, will the correction come every 2-3 years? You see that 20% correction coming in, and probably it's around the corner. And as I said, and Anirudh mentioned, the reasons can be many, but you will only realize it in hindsight what the reason is. And then probably we all would say that it was very evident in front of our eyes, but we just couldn't see it, right? So my guess is that this Bank of Japan issue was a big issue. It is just now put under the carpet. Practically looking at if Bank of Japan wants the investors to buy their yields, they would have to act on rates, which for now they have put it on the carpet. Fed has its own hands tied up in terms of how do they maneuver in the market. Is it 1 rate cut, 2 rate cut? Is good news bad news, or bad news good news? For the markets, it's something that we will see going forward. India has its own spate of worries. There are state elections around the corner, right? If there is disappointment in 1 or 2, we start looking at predicting 29 in year 24 itself, right? So there are spate of worries, and it takes a jiffy for investment sentiment to happen, and markets can correct 20%. And when we are doing investing in equities, it's better to be in an asset allocation format so that we can all sleep peacefully at night, because you don't want to get impacted by the action that happens. So just to give a glimpse of the 4 big corrections that have happened and the reasons which have come about. 1 reason domestic, 3 reasons global. But having said that, there can be both options, global and domestic, which can happen. But we need to be capitalizing on the correction, such a correction that has happened, comes about. More recently, Nasdaq was closer to the 20% correction, which again rebounded, very, very swiftly, right? So what do we do when markets are at one-way rally, and what do we do when the markets correct? Become very important. And Anirudh rightly said, how big is big? Is it 5%, 10%, 20%? Right? Now looks like even a 5% correction is a big correction, right? Because we've not seen one in the last couple of years now. So my guess is that we need to see a bigger correction going forward. The reasons which we will have to figure out only once the correction has been. So we need to be ready for that, and that's where the asset allocation comes into picture. Now we keep debating whether the correction will come or not. One of the arguments that is against a big correction coming in is market is now fairly comfortable with a higher PE, right? So this is a PE of Nifty 50. So in 2005 to 9, we were okay with a average PE of 17 times. 2014 also was 17 times. In 15 to 19, regime change happened, and we're okay with a 23 times PE, and now we are at a 25 times PE, right? Now, suddenly no longer 18 looks expensive. 20, 25, does it look expensive is, I think, is something that we're all, trying to wrap our heads. So the older you are in the system, you would feel that 25 is expensive. The younger you are, you just like 25% is just, it's just a number, right? Because markets are going up every day. But there'll be a point in time where the correction, could come, and the PE re-rating or de-rating, could happen. If you go to the broader markets, just to give a perspective, last 3 years since COVID, Nifty, practically is trailed earnings, which means the PE re-rating was very, very small. In case of mid caps, the re-rating is to the extent of 35-40%, and small caps is to the extent of 50-60%, and micro caps is to the extent of 80-90%. So Broader the market it is, the broader the risk that, broader the riskiness of the market has increased. And that's something that we need to keep in mind. If you go to the next slide, the other argument which we hear is, look, there is a lot of cash sitting on the sideline, right? And just look at the quantum of cash. The bars represent the cash which the mutual funds hold. In July 24, the cash is to the extent of 1,47,000 crores, right? And if we were to put in USD terms, it's closer to about $18 billion is what the cash is at this point in time. Now, this number about 5 years back was minuscule, 25 to 30,000 crores. Now, in terms of market cap, that number was about 0.2 to 0.22% of market capitalization. Today, the number is about 0.32%. So the argument is that if there is a correction market which comes about, then there's a lot of cash which the mutual funds have, which will get deployed. At the same time, anecdotally, even the HNI money is also sitting on the sideline, which is of the equivalent amount, right? So again, this correction, 3%, 5%, the buy-in dips kind of story, would be something that, could be something that is expected. Unless and until there is a macro event, just like we spoke, Anirudh mentioned a couple of points, and I mentioned a couple of points, when the huge correction can come, and what do you do in this particular correction is something that is very important for us to evaluate. At this point in time, we think that it's better to be little conservative. In fact, very conservative, because if you look at other data points, if we just go to the next slide, this is the asset allocation slide. But just before asset allocation, I would just like to point out saying that the riskiness, the froth in the market is there. There are pockets where froth is visible. So at least at our end, we are trying to avoid that particular froth. There are more than 50% of companies in the top 300-400 companies where the PE is greater than 50 times, right? PE greater than 50 times means your yield, right? Earnings yield is about 2%. So are you happy with the 2% number, or do you want more? Is something that one needs to ask. The second point also is that anybody who has deployed cash immediately without worrying about market levels being high, and more the broader the mandate is, they have done well, right? And going forward, we need to really look at whether these kind of managers is somewhere you would want to have the money. The third point is that the returns have been pretty conducive. This year itself, Nifty has gone up 18%. So in 8 months in the calendar year, Nifty is up 18%. Smaller mid caps, were up about 35%. The last 3 years, they're up about 35%. So if somebody has made money, of 6, 7, 8 years in 3 years, is it prudent to take some money off the table and wait for the correction to come and then invest? Is something that has to be seriously evaluated. Good thing is that there is a lot of opportunities available, right? You're not shying away from making yield. I think there are a lot of opportunities to be present. Like, for example, the bottom section of this particular slide, the debt portion, tells you that the debt plus component, which is the hybrid funds, hybrid arbitrage funds, arbitrage plus funds, the long short funds, etc., are a good hiding place where you don't have to sacrifice the post-tax returns, right? And we are pretty much overweight on this particular segment. We also think that the rates could go down, and Swati will touch, in a minute from now, as to what is the possibility of long duration, playing out. So we think that the long duration can be played out, and that is one area that one could, hide away from the market risk that you're taking in equities. And the third is a high yield opportunities. If somebody is very comfortable taking credit opportunities, then there are 9 to 14% kind of opportunities that are available that can be taken. On the equity front, if at all somebody has to be invested, we are very clear on it. The allocation has to be in large caps. Definitely not a proponent of small and mid cap allocation at this point in time. So clearly calling out underweight. And again, like Anirudh mentioned, over medium term, India is good. You will make mid-teen returns definitely, but in the short term, do you want to avoid volatility? Or if you're like, okay, I want to just sit tight and look after portfolio after 5-10 years, then you don't have to do anything about it. But if you have a lot of money and if you are wanting to evade, some bit of volatility, then these are some of the actions that could be taken. So maneuver the portfolio towards large caps, become underweight, massively underweight on small and mid caps, shying away from hype stocks, loading up on fixed income as long as you can, right? And then if you just go to the next slide, very good opportunities in REITs and InvIT space. We like REITs quite a lot. They are providing the margin of safety, probably looking at a double-digit return with both distribution as well as mark-to-market gains. And the other opportunities which are available for people to take, which is the structured credit funds, etc. Gold also looks, very attractive. So it has breached all-time high 2,500. Gold is actually telling, screaming and telling that there is some risk which is panning out. It's just that it's not able to express what risk it is, right? So gold is telling something, and that's a good hiding space. And now with a lot of central banks buying into gold, that could look like a long-term, phenomena. And we treat, gold as a part of, let's say, a non-equity allocation or a fixed income allocation. So we're very, very clear. If there's a volatility, if let's say markets go down, there is one basket which is protecting you. You would want to convert this basket which has saved you into equities. And equities we would want to be for long term, but for a short period of time, have an underweight position, put in gold and fixed income, and convert it in appropriate time. So this is what our call on asset allocation is. One final point which I want to make before I pass on to you, Trisha, is that look, bull market is a place to cleanse old mistakes, right? They are not a place to make new mistakes, right? I just want to leave that message before I hand it over you to Trisha.
Thank you, Shravan. I think that's a great precursor to the next section that we would like to discuss. Asset allocation is not possible without talking about fixed income. Swati, can you please give us your view on fixed income as an asset class today?
Thank you, everyone. So just to update, what has clearly happened is Indian bond markets has become a favorite amongst the FIIs, primarily because of post last September, when the announcement of inclusion of government securities was done in the JP Morgan Global Bond Index. Post that, there has been a consistent amount of buying interest shown by the FPIs in the government securities. And most of the buying was also done in the longer end of the yield curve. That was the primary reason why we saw the yields falling down from all the way from 710 kind of levels to 675 on the 10-year benchmark. So there has been a consistent buying. Close to around 2 lakh crores or 25 to 30 billion USD has been already set aside, and that's where the markets are also looking to invest in. And this was also followed by a lot of traders, a lot of insurance companies, banks buying into longer end debt. So if you see the kind of infusion, and this was done again in staggered manner. So the investment of this 25 to 30 billion had to start from June onwards. So so if you see, look at the slide, this is a month-wise kind of allocation which is done only by the FPI. So in June alone, there was a 14,000 crores kind of investment which was done July, August. So this is the kind of fund flow which has been consistent in the Indian government bonds. I think looking at the kind of longer duration GSEC, we have seen it, most of it has corrected sharply. We have seen close to around, say, 10-year, 20 and 30 and 40 years actually moving all the way down from 730, 715, 20 levels to currently at around 7%. So today, if you look at the 40-year, GSEC has come down to 7%. So that's a good amount of yield correction or downward movement of yields in GSEC. And I think this trend will continue soon. And with government securities coming down, then the next step is definitely the PSU bonds, which also trade at a spread of 40 to 50 basis lower than government securities. So overall, a very interesting scenario currently where the yield curve is slightly inverted, where most of the traders are actually looking in to sell the shorter end of the yield curve and moving or increasing duration in their bond portfolios. So so we have your 1 year close to around say 8% in a AAA rated bond, where a 10 years of the similar maturity is trading 50 basis lower, closer to around 730 to 740 kind of levels. So that's the kind of interest in the longer duration bonds. Now, just on moving on to the next slide, what we have tried to showcase is what is the kind of interest rate sensitivity if one looks to try to play the duration, and how would it pan out. So in most of the treasuries, basically a 10-year which has got a mod duration of say 6 is assuming that there is a 50 basis correction, the yield or pre-tax yield moves to around say 960 or so. Similarly, if one is envisaging close to around say 100 basis kind of downward movement in the yields in a year's time, then their return moves on to around close to around 12%. So this is the actual reason why there's been a significant amount of interest from the family office, from the corporate treasuries. And besides the FPIs, there's a good amount of participation into direct bonds by most of the family offices now, because one can clearly make a portfolio out of government securities and also corporate debentures. I think coming down, if you look at few corporate debentures which we have showcased, the names like HDFC, a 10-year, which is closer to around 7.6 currently, also can end up giving us close to around say 10% to 11% kind of a return in case if the interest rates moves down by 50 basis. So in a scenario where one can actually make a portfolio out of government securities and a mix of corporate debentures, one can easily target close to around say 10 to 12% kind of return without taking much of the risk in the portfolios. So I think that is the interesting part. And otherwise, there are a lot of corporate treasuries who are looking to lock in yields in the shorter end as well, but that would be on a lesser credit names like Shriram Transport and others, which are AA plus kind of opportunities. There one can only play. We would also not suggest to increase the duration in these kind of bonds and to remain restricted close to around the duration of 2 to 3 years, where also there could be a good possibility of making returns close to around 10%. Now, besides all these, there are other opportunities which might come in. The names like REC zero coupon bond, which is like a Bhavishya Nirman bond, which could be one of the most interesting piece which may come in soon. The main attraction of the zero coupon bonds would be definitely like targeting tax-free plus kind of yields, because tax-frees currently are traded closer to around say 5% kind of return, whereas the REC zero coupon bond would be closer to around 6% post-tax kind of a return, which has been expected in the market. So even a zero coupon bond like REC, again looking at the kind of downward trend, could end up giving us close to around say 11% kind of a return. So I think overall we are in a very interesting scenario. We are actually looking to increase duration in most of our clients' portfolios, and definitely would recommend most of the clients to put in GSEC and some amount of allocation in corporate debentures as well.
Great. Thank you. Thank you, Swati. I will now open it up for Q&A. I request everybody to please type in your questions in the chat box at the bottom of your screens, and I'll take them up one by one. We already have a few questions over here, so I'll just start off with these. Anirudh, I think this one is for you. So at current market levels, what is the minimum and maximum drawdown that you could expect?
Minimum and maximum drawdown. As far as Nifty is concerned, I'll be quite comfortable in the Nifty dropping by at least about 7%, which means take about 25,000 down to about 23,900, 20,800 would I think be a fair assessment, where I think would be a pretty healthy correction if that happens. I think beyond that, if the market has to go down, and mind you, mid and small caps can be a bigger casualty. Beyond if the market has to go down, as I mentioned, there would be needing to be a bit more of a potent and a sustainable factor for that to happen. I'll leave you with one short thought. There have been bouts of small corrections in pockets. If you look at some of the, for example, another common investable idea people talk about is the CPSC ETF. The last from peak or so, it is now down about 6, 7% from the peak levels or so. But it's still consolidation. It won't be talked about as correction per se. But I would tend to believe that anything in the vicinity of 6 to 7% should be a reasonable correction.
Okay. This question is also for you, Anirudh. How should investors plan their deployment in equity portfolios, especially given the valuations in the mid and small cap space?
I think Shravan touched upon the market cap preference, which we also did, that the market cap preference remains large, followed by small, followed by medium, but mostly into large. I think that is where the easier part of the answer is. Second is, if you still want to deploy, our thought process is that, you probably will get a better chance to deploy a bit more. So we'd probably say between 30-40% of whatever 100 rupees that you want to deploy, you can deploy now. But wait for a little bit of a correction. This could be a long wait, given how the trend in the market has been. But as the stakes are going high, you probably will get the opportunity to buy. Third point, which I'll probably make, is that it's time to be a bit more selective. In a rising tide, everything moves up, but when the tides are going to drop, there will be still certain pockets which will probably going to be more resilient and have a fair value, which will probably still be resilient and not really be hyped up. So I think these three things is what I would keep in mind when I'm putting money into the equity markets right now.
On a related note, Shravan, I saw another question on this, and I think you can answer this, Shravan. What is an ideal mix between large cap, mid cap, and small cap from a long-term perspective in terms of asset allocation within equity?
No, it actually depends upon individual and how much drawdown one can take. So from a yearly drawdown, one can assume that there's a 20% in large cap and about 30 to 40% in mid cap. So if you can take, let's say the 60-40, 60 of 20% going down and 40-30-40% going down. So if that drawdown something can can take, and that makes the portfolio at 60-40. Otherwise, it's better to start at probably a higher large cap exposure, build some cushion in the equity portfolio, and then going into smaller mid cap. One thing is for sure, if there is a correction in the market, looks like smaller mid cap will correct deeper than that of large caps, right? So it's practically horses for courses. So there's no one answer for this. It is primarily on individual risk.
Right. Shravan, another question for you, and again with respect to asset allocation also. So gold, you mentioned it is at an all-time high. Is this a good time to invest into gold? And if yes, then what is the most efficient way to take gold exposure?
So challenge with gold is that it doesn't have a coupon, right? So it's always dicey to actually give a firm opinion on gold. But when you look at the trends which are happening around, looks like gold continues to remain as a good bet. Take for example geopolitical risk. Right. So we have seen quite a bit of issues happening with Middle East, but there was a report somebody put out saying that there are 84 skirmishes that are happening across the world. Right. So the world is actually becoming much more risky from a geopolitical perspective, and let's say Russia, Ukraine, and Middle East, issues are one of the torch bearers of it, but there are other issues that are. So as long as the issues exist, I think the gold should do well. The second part is the central bank buying. Right? We are publishing in the house views every quarterly, and for the last few quarters, saying that the central bank buying, which was about 250 tons per year till about 3-4 years back, has now touched 1,000 tons, right? And earlier, the go-to for the forex reserve for a lot of these countries is the US treasuries. Now that is coming off, and more interest is going into gold. So that's the second aspect that we think is adding to the gold attractiveness. Usually people work with round numbers. So having touched 2,500, the next target is about 3,000. But the way I see it is gold is an insurance in your portfolio, and you should use your insurance whenever there is a risk off in the market. But as long as let's say there is no risk off and there's a lot of continuity, etc., I would still retain gold to the extent of 5 to 7% in the portfolio, knowing fully well that I may not be using it, but it's good to have it. Again, we have put out in quarterly, saying that whenever there's a correction of 20-30%, gold has actually not fallen much, actually gone up, right? So it is a good hedge to the portfolio. So I would see it from a hedge and insurance other than tracking at levels. But having said that, the trends are, there are tailwinds to gold price to move up. So pretty comfortable with having gold in the portfolio.
Yeah. Mark, maybe you can throw some light on this. So is the Israel conflict a risk to India and to the global financial markets?
Yeah, so I would give. I'm less. I need to know what I know and what I don't know, right? And I'm always thinking more whether it's on India equities or global equities. I've always think, what is the premium I need to assign to equities aside from all of this war, right? Whether it's an Israel crisis, whether it's a Ukraine crisis. It's a challenging one because there's two-sided risk to this. Because if we study the historical wars, we go back to Kuwait, in the 1990s, we go to the 9/11 attacks, we go to, we look at, the kind of drawdown, risk of extent when these wars happen, you don't see a consistent picture. So it's very easy to get swayed by headlines, and investors who are risk averse would start running away, and then the premium suddenly goes really high and is a great buying opportunity, and that drawdown becomes very short-lived. Having said that, the other balance is that today, in the last 5 years, market has been almost too optimistic that suddenly the risk premium is too low. Oh, it's okay, Israel continues, but the Fed is going to cut cycle, right? You can create your own narratives depending on what news you want to pick. So the challenge then is, what is the fair risk premium to that? My answer at this point is there is a bit on. I can't say for India. Maybe Anirudh will be better placed to say that. On the global equities, whether it's US or global equities, the risk premium on war should be. It's quite fair. I don't really see excessive risk aversion, nor do I really see complacency, because I think the bigger issue it's more to do with, a growth scare. That means, as global central banks are keeping monetary policy tight, is that triggering a lot of hard landing, not just in the US, but, in Euro, Australia, that I believe domestic economic cycle has a stronger impact than wars. Of course, then, and this is also leads to my second point, why wars have not really a consistent relationship, and one should not, be overly risk averse on war, is because while on the headline, you can associate wars with equity drawdowns, there is a lot of confounding factors that do the wars coincide with, the economic situation in that country. So ultimately, just is a long-winded way to answer that one should monitor it, but you should not be overreacting to headline news, and always focus on the valuations and the fundamentals.
Great. I have a question for Saurabh. Saurabh, how important do you think, or how well do you think alternates could play as a tool to asset allocation, whether it's alternate debt or alternate equity? Also, on a related note, on alternate equity, what do you think could be an ideal mix for investors in today's lens?
I guess it's a very good question, especially for the Indian investor diaspora. For very long, we have always been thinking of investments as equities and debt only. I guess if I go back prior to 1990s, or maybe prior to even 2000, I guess for us, investments primarily meant real estate and gold for majority of the households in India. Thankfully, from the start of this century, while property and gold has continued to remain a attraction for the Indian households, but equity and debt has become the bigger pie of the financial savings that we are seeing. And now we have started seeing the grassroots for alternate debt and alternate equity. If I have to prophesize, and I guess we all will fail at prophesizing eventually, because that's not the skill that any of us have on this call or on the panel today. But still taking a hazardous guess, according to me, by the time we end this decade, there's a very high likelihood that all the family offices, HNI, UHNIs will start having at least three asset classes in which they will be investing, which will be equity, debt, and alternates. So alternates is here to grow. I have seen in the last 1.5 to 2 decades, alternates having grown from next to negligible allocation in the highly sophisticated family offices to today they averaging anywhere between 15 to 25% of the total portfolio. So that trend is very clear. And for some of these macro pieces, I always say history always repeats itself. So if it has happened in the Western economies, if it has happened in the developed economies, then there is no reason why it will not repeat itself in India. So both alternate debt and alternate equities will play a very important pivotal role in times to come. One very important critical thing that always leapfrogs these two asset classes is the tax arbitrage that a country presents to the listed equity or the other asset classes. And that was a big handicap that has been taken out of the way by the budget this time round. So if you see today, all asset classes are more or less brought at the same level playing field of long-term capital gains after 2 years and 12.5% standardized taxation on a plus basis for all asset classes. So now literally everyone will get rewarded for the risk that they are taking. And there is no tax arbitrage which is available to any asset class, which puts them in an advantageous position so far as clients' asset allocation is concerned. So with that as a perspective, today, where your AAA and AA and the long-term trend in debt is, let's say, the downward sloping curve. And as Swati was saying that some part of correction has already taken place in the yields, even though the rate cuts have not yet started, and some more will take place when the rate cuts start. I don't think so any investor will feel justified for allocating to a 7% or a 8% pre-tax product on a fixed income space. So they will have to compulsorily look at the alternate debt space, whether it is performing in structured credits in the handle of 13 to 16%, whether it is those special situation credits, which will be from 16 to 20, or the distressed credits from 20 plus. In addition to that, I guess InvITs and REITs are another fabulous alternate debt space that is coming up, emerging up. Some of the wealth players in the industry have already started calling them out as fixed income asset allocations. So whether it's fixed income or alternate debt, but InvITs and REITs are another interesting space. So far as alternate equities is concerned, again, we have seen a decent amount of appetite for the angel investing, VC investing, private equity investing. So I guess tech-based investing has been calling the shots for the last few years. We also now are seeing the late-stage pre-IPO funds since 2018 having consistently figured into the wealth space and in the asset allocations of the clients. And now the new advent is getting into these stocks on a direct basis. So I guess the direct stock investing culture in the listed space has now also influenced the unlisted investing space of the clients. And now the clients are even more courageous enough to go for the direct investments in unlisted equity. So both these asset classes collectively, I won't be surprised if they land up commanding anywhere between 25 to 35% of the client's asset allocation by the time we end this decade.
Great. I have a question for Swati. Why should one look at the REC zero coupon bond? What is the advantage of it? Swati, if you can just delve a little deeper with respect to the tax advantage, etc.
Yeah. So REC has come out with would be coming out with a Bhavishya Nirman bond. So these bonds were actually the last time they were issued was around close to around say 15 years back, when there was NABARD which had come up and which was given a Bhavishya Nirman status. That means it would be clearly that post 1 year, if you sell it, it would be a long-term capital gain. Other zero coupon bonds are definitely a gray area, because that's a very, very clear indication that you have to account for in March for any of these coupon bonds. You cannot take it like a long-term capital gain for the corporate entities. But in Bhavishya Nirman bonds, it is definitely can be taken as a capital gain. So somewhere close. So in case one gets close to around say 7% kind of yield, one can clearly expect one sells it after 1 year. You can actually look into take a 12.5 plus kind of a taxation in it. So therefore, post-tax returns in this REC Bhavishya Nirman bond would definitely be much better than your tax-free bonds which are available in the market. So tax-free bonds currently being traded around say 5% to 5.25%. And if this Bhavishya Nirman bond of RDC would be closer to around say 6% post-tax. So that's a big difference.
Right. And it also has the duration benefit, right? Because
it definitely has a duration benefit, which we have showcased.
correct. I have a question for Anirudh. So markets have been driven by liquidity from domestic investors and valuations are already high. Do you think FIIs who have not actively invested so far will continue to sit on the sidelines? Specifically because there are limited investing avenues, and if they do invest, wouldn't that continue continue the liquidity flow and refrain the markets from falling?
Well, it's a good question, and I think we need to delve a bit deeper into where do FIs really invest in. I think last I checked, the biggest ticket investments for FIs have always been the financials and IT because those are the most liquid stocks. But incrementally, little flows that have come through this year have gone into the capital goods space as well. I think the one sector which has probably not participated too much into the rally has been financials, whereby the price to book multiple has just been 2 times and it's been there in sync with this long term average. And it's usually a very, very favorite stock as far as FIs are concerned. So my sense is that the FIIs, if they come back, and particularly in case the DXY looks to drop, X percentage of, to my mind, FI flows will go into the bigger sectors, notably financials, because financials have also not, they're also not, to answer the question in the right context, the valuations are not expensive actually. The valuation pretty much on the risk reward basis, probably the fair amongst all sectors that we can see. Something may be driven actually. So will FIs come, or will they be forced to come? Let's say that every time there's an increase in the weightage of India in the MSCI, they'll be forced to put in some amount of money. If DXY drops and emerging market flows increase, some amount of flows will come to India for sure. So to my mind, FIIs, if they come, they'll probably need to be a bit more selective, or they will probably be a bit more selective, but they'll enter into areas where traditionally they have been big buyers and they've not seen valuations move up. What it means in terms of markets, well, depending upon which index do you pick, from small cap to the Nifty 50, the BFSI space typically is about 28 to 30% of the index. So if FIIs come and make a beeline as far as that sector is concerned, then at least 1/3 of the index will remain buoyed. Even if the other part of the indices are they do crumble under a little bit of a selling pressure. So my sense is that they will probably come maybe a little bit by the change of India's increasing weight of India. Will the money flow into the hype names? Unlikely. But they'll probably flow into some of the more common names and more liquid names, which they think they're quite comfortable with over the years.
Okay, great. There are two sector-related questions, Anirudh. I think you can answer these. The first one is on banking as a sector. Do you think this deposit issue, how do you think is going to turn around, and how long will the stock prices continue to be eclipsed by this issue?
Well, I think the two parts to the question. I think as far as deposits is concerned, I think CASA is probably going to be under pressure for some time. There are two things which I've read. One is that as long as RBI begins to make its policy stance more neutral, there'll be more liquidity available, and it is going to ease the requirement or the ability for the banks to get money. Second is we've already seen some infra bonds being raised by various banks. So there is alternative route as far as raising deposits is concerned. But yes, and term deposits, it still remains the biggest source as far as the balance sheet lending capability is concerned as far as banks. And there, I don't see too many people raising a query at this point of time. The query is mostly about CASA. Now, the difficult to say when it's going to the cycle will turn, but the fact would remain that ultimately, if money is going into credit and credit is going to put money back into the deposits, it's mostly going to be cyclical in nature. That's the thing which I get from a couple of the economists who say that, look, over a period of about 6-8 quarters, you'll find that this ratio begins to normalize by itself. In the interim, if banks need to lend, I think there are other avenues, as I mentioned, on infra bonds, and they're also hoping that maybe the RBI may not cut rates. That's still debatable, but the policy stance turning to be accommodative or neutral, perhaps forget about accommodative, will at least do things which are going to be going to ease the tension a little bit. Second part was stock price performance. Now, I think the stock performance is not got to do too much with the capability or the deposits per se. I think it's got to do with two things. One, we had the peak of the asset cycle in FY24, which was even management's, everybody mentioned it will be the peak, and there's going to be a bit of a deterioration after that. Coupled with that, the kind of narratives that we have seen from the RBI and about the lending growth being a bit too much in certain pockets and people beginning to question certain underwriting practices or so. That, along with, every 1 month there is somebody, some financial institution or the other, which has gone into a bit of, I would say there's been an imposition of either abeyance or suspension of certain activities till the time they rectify the systems. I think that narrative itself has led to a little bit of, I would say, lackluster interest of investors into the banking space. It also doesn't help that the PSU banks went up drastically. So as a banking space as a whole, if you want to cut between the two and you cut private versus public, so public has already run up quite a bit. So there's a bit of a tapering down. Private banks, because of moderation of growth, and now with the cycles turning, thinking that the NIMS is also going to moderate. So the earnings kicker for the banking sector is not going to be coming up for the next some time. And I think valuations are adjusting to that. Having said that, I would probably say that, this is probably pricing in a lot of the moderation of the cycle and the NIMS and the deposits already. So wouldn't be surprised in the market, begins to say that, look, we already know all this and we've not really gone into the sector, and just by way of rotation, you begin to see the banks perform a bit better. But I think the reason for not performing the banks is probably not just the CASA related issue. I think there's a couple of two other things which I mentioned.
Yep. The second sectoral question that we have is on pharma. Specifically, what is your view on pharma as a sector, Indian pharma as a sector, and specifically in the context of a US Biosecure Act?
Okay, so pharma as a sector has done phenomenally well. I think it's one of the top 3 performing sectors this year as far as valuation and stock price returns is concerned. And I think the reason were twofold. One, of course, is that, that the whole launches that are there were always lined up for CY23, CY24 for major drug companies. Secondly, there is easing of a supply chain across the board, which has given big benefits as far as operating leverage is concerned to most companies. And the US pricing pressure and the inventory destocking was mostly done. And I think that those pressures have eased. What is about Biosecure, to my mind, and pardon me in case I don't know this fully, but Biosecure Act is likely to be passed by the government of USA soon. It typically impacts the CDMO, service providers out of India, the likes of probably the Divi's and the Glands and all these other companies of the world. It is broadly said, it is supposed to be mentioned that if the Biosecure Act is indeed adopted by the US, it is going to impact a few of the Chinese players when the India to China plus one opportunity for India could open up. My sense is that it is, while indirectly that is going to be correct, in case India still sources the intermediates or the backend from China, then again this opportunity may not fructify immediately. Nevertheless, Biosecure Act, the way it is, if it gets passed in the US, would typically open up more avenues as far as the Indian CDMO space is concerned.
Okay, thank you. Mark, there's a question here for you. Do you think the China story is over? Should investors look at China as a geography?
I was about to type the answers to that, and fortunately, you brought that question up. So let me address that. And we are about to publish an opinion piece, so you will actually see a content exactly on this question. The answer is no. Really, and the title of this opinion piece is "Do not discount China in your EM equity portfolio." It's very easy to extrapolate, the negative macro headlines, and global markets have always liked to naively almost associate macro with equity fundamentals. And unlike in the developed markets in US or other European stocks, emerging markets, not just China, but overall in emerging market, there is a very strong decoupling between GDP growth and the equity forward returns. And there are many reasons for it. Uniquely in emerging market, every emerging market has very high GDP potential growth. Why is the developed market equity still doing really well? Right? For the very reason that some equity markets are very shallow and they don't represent the economy. So you might say that maybe Brazil and Mexico has a very high GDP growth potential, and then you open up the bonnet on their stock market and you realize that half of it is state banks or state enterprises, which has very low return on equity. So, and China is no different. For international investors who want to access China, a lot of the domestic stocks are not even accessible to international investors. So many international investors, if they want to access China, they will invest through the Hong Kong listed China stocks. And what that means is that you will end up investing in a lot of Chinese tech companies, and they have very idiosyncratic issues. The government tech crackdown that is irrelevant to the GDP growth and all of that. So then you will have this divergence between equity performance and GDP growth. So the first concept is that, GDP does not really have any sort of predictive power to emerging market equities and even to China. In fact, we will show exactly that statistic when we publish that opinion piece. But let's think about other positives as well in China. Actually, earning fundamentals, as we already decouple, why, GDP does not correlate to China equity returns. And if you actually look at the earnings fundamentals, it's not as bad as what the macro headlines suggest, right? You won't see a shortage of news on the negativity, deflation, is China going to collapse? But if you look at the equity fundamentals, consensus earnings outlook, I highlighted this earlier, is actually 14% financial year 2024 and financial year 2025 on 12% earnings growth. Of course, there is some low base effects, but then why is the consensus earnings growth estimate so robust? And the answer is, a lot of the companies, I can name you two examples, have the ability to generate free cash flow, and the global markets are just indiscriminately punishing the aggregate China index just because of the negative headlines. I give you an example. Alibaba, everyone would know Alibaba. And it's quite puzzling to realize that such a high growth company with a growing cloud business, a very stable e-commerce, and is a cash flow printing machine, and they're now priced at the forward 12-month PE of 9. That is almost implying that, Alibaba has very minimal terminal value. If you kind of do a discounted cash flow and you kind of value it, it has very minimal terminal value. Does it really imply that Alibaba is not going to exist in the next 10 years? We don't think so, right? So it's kind of, the story is certainly not over. China has a lot of negative macro headlines. Global investors who don't do their due diligence and not identifying these hidden gems, they're going to just, dump Chinese stock. Is very hated in the international market. But you can use this opportunity to pick up gems like Alibaba. In fact, if one more less common name, Gree, is actually, China's leading household appliances. And, the government, in its attempt to try and stimulate domestic demand, they are already offering subsidies to households to switch their old appliances to new appliances. And Gree, which is the largest, not just regionally, but even globally in aircon manufacturing, is going to benefit from that. What is their forward PE? 7. Right? It's even worse. So you can actually find a lot of these. The story is certainly not over. You do have to find quality companies. There will be purging. There will be property developers that are over leveraged and they're going to get purged. But if you can find some of these moats, in Chinese company, certainly the story is not over. You just need active selection. And this is actually a great time for contrarian investors to pick hidden gems. So certainly to long answer to the question, no, the story is not over. Don't get swayed by the negative headlines.
Thank you. Thank you, Mark. Shravan, this question for you. What is your view on the IPO frenzy that has been happening, especially for a lot of the new age businesses?
I think in general the frenzy is maddening, but specifically I think there are great opportunities, that are coming, the market way, which needs to be analyzed selectively and to be invested. But broadly, I think there's a lot of frenzy, especially in the SME space, calling out just to be very, very careful there. In case of main book, I think a lot of companies are doing good. In fact, there was a presentation made by SEBI chairman, SEBI director very recently saying that the demand for equities is high and less supply is coming. So in the light of so much of activity happening, also there is issuance is lower. So you will see that I think there's a need for more issuance to come. Apart from the IPO market, there is also some bit of activity happening in the QIP space, which is also very exciting. But one that should take a selective bet on companies rather than whitewashing it with generic statement.
Yeah, thanks. Mark, there's another question for you. Will the de-dollarization happen in the near term, and what the impact of this could be on Indian equities?
Yeah, excellent question. I have thought of this very deeply because this really is one that can impact the US rally. Of course, my mandate is to cover the offshore, and US equities are very popular. And what could go wrong with US equities? And you need a couple of wheels for the US rally to really collapse, and one of that is de-dollarization. But then the question is, will it happen in the near term? No, for a very good reason that the world capital markets have been intrinsically tied to the US dollar. So if you think about, for example, I just mentioned earlier on, a lot of emerging market economies, the sovereigns want to raise debt. No global investors is going to borrow to an emerging market economy if they don't trust the currency, if the emerging markets can just simply print away and inflate away and weaken the currency. So a lot of the emerging markets have no choice but to actually borrow internationally via USD. Right. And then, of course, even the markets are punishing them by having a high spread because, some of these governments might not even want to pay back international investors. So that's a different topic. But you can see that this is already a structural tie-up that, the capital markets are very tied to US dollar. Commodities are priced in US dollars as well. So it really takes it's a kind of a 50-year, 60-year phenomenon for a new global currency to really emerge. We kind of see, certain currency blocks. Euro was the other contender, but, Euro has its own structural issues why the Euro cannot be the global currency. I mean, even Euro can't even be its own regional currency, let alone the global. So there's a lot of attempts, but when you have a capital market that is so intrinsically tied, to the US risk-free rate, sovereigns are issuing in USD, international corporates are issuing in USD, it takes a long time for the de-dollarization to happen. Now, does that mean that, the US dollar is not likely to weaken? No, but to get the kind of the drastic de-dollarization would take many, many years to happen.
Thank you. Thank you. Yeah, so one question for Shravan here. And I think this will be the final question. I think we've run out of time. Shravan, what do you think? Should we book profits? Where should we book profits from? And on a related note, if there are SIPs happening into small and mid cap PMSs or mutual funds, what should investors do with that?
See, if your portfolio is consisting of large cap, mid and small cap, booking profits from small and mid cap makes sense. That's the first go-to, segment. Secondly, if there are stocks that have already made a lot of money for you, that is a place to, book profit. Sit on the sideline. Market is not running away. You will get opportunities, and hopefully this is a long-term trend that we're looking at. Make use of, some low volatility, stocks in the portfolio or funds in the portfolio. High quality, low volatility, large capish, segments are the place to, look at one's investment. Look, if somebody has a 10-year view, don't want to do anything about it, that's completely fine. But if somebody wants to ride out on volatility, it makes probably sense to go overweight, and then, come back as equal weight. As we said, right now, the discomfort of the levels of the market is there, not too disturbing also, but at the same time, discomfort is there. So it's better to staying away for some period of time before coming back. Again, there are other opportunities. Like one of the questions are, say, if FIs come back, will it not be adding any liquidity, etc. So that's where the large caps also come to play a role, and that to growth stocks could be the place where the investments could happen. So there's one segment of market where you can participate in, at the same time being underweight and not getting hit by the volatility that you would see in, or the drawdown that you would see in the other segment of the market, which has gone up significantly.
Great. Thank you. So that brings us to the. Sorry, just a second. That brings us to the end of this webinar. I think the key takeaways are that we have, as wealth managers, seen a huge shift in risk appetites of our investors over the last 1 year, one and a half year. And a lot of it has been triggered by some of the tax changes that have happened in the fixed income space. I think our key message to clients is that asset allocation has always and will always remain an effective, disciplined approach towards investing. One should not ignore it. Equity markets are here to stay. India growth story is strong, but don't let any correction catch you unaware. Asset allocation is a great tool to make better returns when equity markets fall. And one should stay disciplined, stay focused on just generating that alpha. The fear of missing out is huge, but keep yourselves insulated from it. I think that's the key messaging that we wanted to bring out today. Timing of correction is not possible, but never say never. So with that, we'll wrap up the session for today. Thank you so much for joining us. We hope to see you again next month.
Thank you.
Thank you all. Thank you.
Thank you, everyone.